always going forward, if you're not already, always as the market goes up, get more vigilant. Yes, you still want to make money. I keep repeating this. Yes, you still want to make money as it goes up, but you can do it in a lot safer way by putting on hedges at that time. When Palantir or whatever stock you're in starts to drop, it's going to be super expensive to buy anything on that put side. Do it before the hurricane hits. Do it before it's even on the radar. Let's jump over here and let's talk about the long dated strategy. Now I'm going to go with Palantir. And the reason I'm going to talk about Palantir is because it's one of those high flying stocks right now. We have a member, you guys, that I did a one-on-one with, and he got into Palantir when it was like around $20 a share or something like that. And he's got a ton of shares. So Palantir has made him a millionaire, and he's still riding that wave. I don't think it's done. I don't think it's might not even be close. If you remember, what was it, 2022, when Nvidia jumped off and it shot all the way up, you would think that when it was up, 70, 80%, 100%, 200%, 300%, 500%, it would have been done. Nvidia is up over 1,200% since that time. Right? So I don't know the statistics on Palantir, but I'm sure it's not like that yet. This could be the early innings. I still think, believe it or not, it could be the early innings of Nvidia. Think about how much Microsoft is up since it did its IPO. Yeah, I know Nvidia wasn't an IPO in 2022, but it wasn't a household name at all. And then it hit gold, it struck gold. Well, I'm just saying it's thousands of percent Microsoft is up since it went public. Let's focus on a company like this using a long dated type of process. So for me, if I was doing this long dated type of strategy, and I just say a year, 6 months to 2 years out, right? Ernie does 6 months to a year and a half, let's just say. But I'm going to say 6 months to 2 years so we can have a little range here. I would not be initially bearish on this stock at all because I believe the risk is to the upside. The velocity of the move, I believe, could be to the upside with this stock. For me, I would be selling the puts, and I would only add the call side if I just absolutely had to adjust that put. Because the long dated strategy, guys, it's not taking ownership of the shares. It's a trading strategy. You're not trying to take ownership on holding it for like the safeguard strategy. Let's just say I went out to, let's say, September of next year. So it's about a year from now, a little over a year. This is 402 days, so a little more than a year. Let's just say I went down to this 3 delta and I collected $232. Well, even in a non-portfolio margin account, this is still an amazing return on your capital because you only have to put up $650 here. You don't have to put this amount up because you're not trying to own the shares. You're not trying to take ownership of the shares. So get that out of your mind. Get that safeguard type of concept out of your mind at this point. Your return on your capital is your buying power. This could span, just like with span margin and options on futures, this could grow if volatility spikes up. And volatility is low right now. We're at a 14 handle. We're about to get into that complacent level if we hit a 13. Right? You can call it semantics. You can say we're already near complacent because I like 15 to 17 range. I think that's normal. You have to be careful with this, even though looks like a crazy attractive trade with portfolio margin. This might be $100 to in buying power instead of this 649. It might be positive money depending on what you already have on your account because it's based on your portfolio. This is significantly far away for the next year. It's at the 65. So if we take that and just do a percentage from where it's currently trading at, you take the 65 minus this 187 and divide it by the 187. So 65 minus 187 divided by 187 equals 65%. It would have to fall 65% to touch this strike. Is it probable? No, it's possible, but it's just not probable it's going to drop 65%. But I can easily see it going up 65%. Based on what I just said, how Nvidia and how some of these other stocks have went up, not 100%, but thousands of percent. So I do believe it can do 65% in the next year. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. If I did this trade though, and I'm using portfolio margin, I'm going to take some of these monies and I'm going to hedge. So I'm going to hedge 6 months out. I'm going to hedge even potentially a year out. But most of my hedges would be about 6 months out. And I'll constantly having hedges go out using the long dated strategy. And so in this example, if I had a $239, if I was going to take, let's just say 30% of it, and sometime I will take up to 50%, depending on how much I have on. But if I was going to take 30% of this, that would be about $70. So let's just go, and let's just go to the SPY, for example. This is a indirect but darn near direct hedge. A direct hedge would be doing it in Palantir. And we can look at that in a second as well. But let's go to SPY, because I would build most of my hedges in a portfolio margin type of account in the SPY to help the overall account offset losses when it starts to drop. So if we go 30 times 6 is 180, so that would be 6 months. So let's look at about 180 days. We're going to go to this 171, or we can go to this 220. Let's go to this 220. If I went here, you can see if I was going to just try to buy this outright, it's going to cost way more than $70. If I turn it into a spread, this can hedge me about $400, but that's still going to be about $90. So if I was willing to hedge a little bit more, I can do that at the 30. And keep in mind, I have a bunch of these over time as I'm doing these type of trades. But in this example, I can move this down and do it for cheaper. Keep in mind that Palantir one was about a 3 delta. So I'm buying this here at let's just say a 17 delta. So this is going to cost me about $53, $55, let's say, to get filled. And this is going to hedge me $500. So if Palantir is going to drop 65% and it's not due to individual kind of company risk, if it's just an overall market drop, then this will help me a ton, right? So every time I put on a position like this, as the markets continue to go up, I would continue to try to find hedges, mostly in the SPY. Now, if I was going to do one in Palantir and we go out 180 days, let's just go to the 220 as we were in. And let's look at going at and near the 30 delta first. So if we did that, you can see that's going to eat up a lot of the credit that we receive, because it's only going to leave for $42 now, because I still got that naked put down at the 155 or 200 or excuse me 402 days to go. So I'll have to move this down more to get something to do something cheaper. So this would work, right? Ernie most of the time wants to collect at least $100 when he's doing these long dated trades. Well, this meets that criteria. You can see that we're collecting 101, but now we have a direct hedge. It's going to have to go through this before it gets to the 65 strike. We would have a max hedge on this trade here. And you can see we did it for free because we sold that put. We took some of those monies and we bought the hedge, and this is going to hedge us $500. And you can see it didn't change the buying power significantly. And with the portfolio margin, it might give you this for free, like I said. But this is a trading strategy, but you're not getting too big. When the market is going up as much as it is, and it has a tendency to go up, like as I've been talking about, you have to get more vigilant. You're still going to make money if it goes up, but you have to fight the urge of being too greedy. Always going forward, you guys, always, if you're not already, always, as the market goes up, get more vigilant. Yes, you still want to make money. I keep repeating this. Yes, you still want to make money as it goes up, but you can do it in a lot safer way by putting on hedges at that time. When Palantir or whatever stock you're in starts to drop, it's going to be super expensive to buy anything on that put side. Do it before the hurricane hits. Do it before it's even on the radar. I want to point out another type of way, if you're doing the long dated strategy, another way to make sure your buying power situation doesn't get out of hand. I was talking about that I wouldn't put on calls, or at least a lot of calls in this environment at this point, naked calls like strangles. I would focus on the put side and then take some of the premium and buy hedges, as we discussed, and only add that call side, or most of the time only add that call side if I had to adjust the put side, because that's how we adjust, you guys. We have to balance out the kind of scale there. They have the equilibrium. One side has to be moved and one side has to be, adjusted to be, or added or adjusted to be able to take care of the debit that is happening when you're moving a tested side type of trade. But if you want to sell that call side, I would recommend you do about 25% at least of long dated using the collar strategy. And the reason why I say that, because if it goes up, you have no risk. That means you're making money because that call is covered. If it goes down, you have that put to kind of protect you at least to a certain point, which will offset your buying power. That can be an awesome, awesome way to keep the buying power situation under hand or under control, I should say. We used the example of Palantir of putting on a long dated put, selling a long dated cash secured put, or not necessarily cash secured, because this long date is not cash secured. You're not trying to own shares. But in this case, I would incorporate a collar, which obviously you own shares, into the long dated process to be able to deal with the buying power even better. We were talking about selling that naked put and then taking some of the premium and buying a put spread. And that's going to offset buying power because you're doing something bullish and you're doing something bearish. In this case, you'll be doing something bullish and you'll also be doing two things that's bearish: the selling of the call and the buying of the put when you do the collar. And so 6 to 18 months, 6 to 2 years out. So if we go here again, and let's say we go to this 191 here, and we do a collar, and I just say I think Palantir is going up quite a bit. Anyway, if I sell this call at the 250 there, and then I buy a put for less than the 1260 that I'm receiving here, then you can go here, and I just say to protect myself, I buy a put here at the 140. All right. So in this example here, in portfolio margin, this might, because you're putting on that put, this this buying power would probably jump down to like $1,000, from 9,000 to $1,000. That would probably be the buying power, if not better. Okay. And then you would still have $6,700, a little over $6,700 you can make to the upside over the next 191 days, over 6 months. You're getting a credit on the options of 250, and it's going to really solidify your buying power. So if things fall, which most things, 90 plus percent of stocks follow the market. So if the market is going to fall, most stocks are going to fall. And your buying power situation, when you have naked puts and naked calls, could bloom up, could go up significantly. You want to be able to offset that. So using a collar on about 25, at least 25% of your long dated stuff could really help to the upside and really help with the buying power scenario. If you're using portfolio margin, the collar doesn't affect your buying power too much. So why not do it? Why not offset a lot of the risk to the downside and a lot of the buying power risk if the market drops a lot?